Hello and welcome to Lipper's Fund Flows Insight Report. I'm Jeff Turnahoy. For the week ended August 21st, 2013, the conventional mutual funds industry saw fairly light trading this week as investors were probably sitting on the beaches of Martha's Vineyard or enjoying the hills of the Hamptons. But let's take a look at our macro groups and see exactly where those numbers shook out. Starting off at the top, equity funds had about $2 billion in net inflows. Taxable mutual funds had outflows of $1.5 billion, municipal debt funds had outflows of $2 billion, and money market funds took in about $10.7 billion. Well, as I mentioned, late August tends to have a seasonal effect on trading activities and flows activities by investors. Both tend to be fairly light, and sometimes we see strange changes in the market. Let's turn our attention to equity funds and look in greater detail. As I mentioned earlier, about $2 billion in inflows this week. This comes after 6 consecutive days of downside performance in equity markets, and normally that would shake people, but and as we'll see, it did have an effect on ETF investors. For mutual fund investors, their set it and forget it programs weren't going to be interrupted. We saw fairly quiet news on the economic front, although a lot of indicators recently have been trending south. We saw reports this week from Producer Price Index, Consumer Price Index, retail sales, and a few others, all either lower in July than in June or lower than expected details. So overall, the economic news is starting to get a little soft, but we'll see where the final numbers shake out later on, as these are mostly preliminary views. The only few bright spots among equity inflows this week were Oakmark International funds. They took in about $900 million. I'm sorry, that was the International Multi-Cap Core Funds took in about $627 million. Oakmark International was a huge portion of that. Equity emerging markets also saw inflows this week, about $567 million, and domestic large cap was the real loser this week. They had outflows, whether that was growth, core, or value styles. Now, as I mentioned earlier, equity ETF investors had a different view altogether of this week's activity. They had about $11.4 billion in outflows. This is the largest outflow for this group since September of 2011. Now, that might seem like something's really changing, but in fact, if we look on it on a proportional basis, $11.4 billion in outflows for equity ETFs is very far down the list in terms of flows versus assets. This might be like the 100th worst week in their history. The real activity, of course, was centered on SPY, the S&P 500 ETF. It saw outflows of about $10.3 billion this week, followed by the iShares Consumer Discretionary. It had outflows of about $617 million. So overall, the really investors were focused on just getting out of SPY. Some groups did have some mild inflows this week. We saw MSCI EFA EFA as well as the EMU version of, I think that is EZU. They both took in money this week, as perhaps investors were going to take a flyer on Europe recently as things have started to settle out there. Well, let's turn our attention to taxable bond funds. Again, they had outflows of about $1.5 billion this week. Let's look at that in detail. It was a tough week for them. The loan funds are really one of the few bright spots out there right now. They took in about $1.7 billion. High yield funds were the real losers, though. They had about $1.3 billion in outflows, and even the standard core product intermediate investment grade funds also saw outflows of about $1 billion this week. Not too much for investors to get excited about. Another tough week with performance trending on the downside. If you are a fixed income ETF investor, things weren't quite so bad, though. These funds, although they had outflows, again, were mostly focused on high yield, which had outflows of about $1.1 billion altogether. HYG was a real culprit this week. They saw outflows of about $725 million. LQD, although certainly less of a credit play than HYG, it also suffered some pretty good outflows, almost $500 million this week. There were very few areas with inflows this week, mostly short duration treasury products with $100 million here and there for inflow. So not much for fixed income investors to get excited about on the trading side of things. Well, the next group we'll take a look at is municipal debt funds. They suffered about $2 billion in outflows this week. Things have not been going well for munis. Just like the Treasury market, they also had tough downside performance this week. They have 13 consecutive weeks of inflow, and as we've seen in our past history with municipal debt funds, they tend to have their outflows come in a bit longer periods as investors assess some of the macro conditions out there. Outflows have been proportional to assets, so investors have not been taking a strong view of state-by-state issues, of which there are several right now. Rather, just whatever they've been investing in for the last several years, they're starting to peel money back out of. So we'll keep our eyes on this. I don't expect this to change anytime soon. The final group to take a look at is money market funds. While they had inflows of about $10.7 billion this week, there didn't seem to be a whole lot of direction as far as investor preferences. We saw institutional investors allocate about $4.6 billion to their cash accounts, while retail investors added about $6.2 billion to theirs. Looks like people were just putting some money on the sidelines. Perhaps some of that was from taxable and municipal debt fixed income funds and ETFs, which all suffered outflows this week. So there could be just more money being put aside and maybe used at a later date when things start to turn up for those products. Well, that'll do it for this week's Flows and Analysis. Join me next week when we can take another look at what's going on with mutual funds and ETFs, or join us online at any time at lipperusfundflows.com. Thanks for watching.